Live from Sydney, I'm Paul Allen, and this is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Oil jumps as Iran's intercepted missile attack on US forces revives fears of a wider Middle East conflict, sending investors into risk-off mode. The chip sell-off sweeps across Asian markets after SK Hynix misses profit estimates. Korean stocks tumbling as investors question the durability of the AI memory boom. Traders also weighing the risk of a surprise Fed rate hike later on Wednesday, adding to market anxiety fueled by geopolitical and technology shocks. BlackRock's APAC fixed income head Navin Saigal will tell us why he thinks the Fed might stay patient and why Asian bonds could outperform despite global uncertainty. Also, Rio Tinto CEO Simon Trott joins us exclusively after the world's second largest miner posts surging profits and declares its highest interim dividend in 4 years. Let's take a look at our markets tracking at the moment. Want to start with the green square on the bottom right of your screen. It's here in Australia, the ASX having a pretty good day, better by 1%. Rio Tinto, the big miner, one of the best performing stocks on the index after a 47% year-on-year jump in first half. Big dividend there as well. But elsewhere around the board, the pictures gets a whole lot uglier. Anything exposed to the tech sector taking somewhat of a beating today. We got the Kospi off 7.5%, really inspired by that big decline in SK Hynix, now off more than 11%, 11.6% now. SK Hynix did deliver 557% increase in profit, but no, not even that is enough for the giddy estimates around the AI trade at the moment. The sidecar for the Kospi was activated again, seeing Taipei's TAIEX index off by 4%. Some softer declines for China's CSI 300 off by a third of 1%. But oil also jumping today again. This is after Iran launched an attack on a US base in Jordan. CENTCOM say those saying all missiles were intercepted, but on a larger level. That does shatter 3 days now that we've had of relative calm. Also hanging over markets, what's the Fed going to do? Pricing a 1 in 3 chance of tightening, so a bit of uncertainty there as well. But let's get to our top story. The US saying it intercepted an Iranian missile attack, ending a days-long pause in fighting and increasing the risk of a return to a full-blown war in the Middle East. In a social media post, Central Command says it successfully intercepted all of those ballistic missiles launched from Iran against US bases across the region. The regional command also says US and Saudi forces hit back against Iran-backed militants in Iraq. For more, let's get to our Middle East correspondent, Abir Abu Omar in Dubai. Abir, thanks as always for joining us. So a few days of calm shattered, just underscoring how fragile the situation is in the Middle East at the moment. Can you outline for us what happened and what it means for the chances of a lasting ceasefire?
Yeah, good morning, Paul. I mean, as you just highlighted, it's not necessarily about the degree of the damage because the U.S. Central Command did say that it intercepted all the missiles that were directed by Iran, but it's just about the tensions or the re-escalation that we've been seeing in the region. And again, as you have mentioned, we've seen days of calm since Friday evening when the U.S. all of a sudden stopped attacking Iran after 13 consecutive nights of attacks. Iran saying on Sunday that it will suspend attacks, and then this morning or overnight, we saw Iran hitting back on bases, U.S. bases in the region. Central Command saying it intercepted them, but this opens the way for further escalation or a return to hostilities. We obviously will await to see what President Trump says when the U.S. awakes. But then again, you also mentioned the Saudi story, and this opens new fronts in the war. Paul, we've seen the parallel war happening, or the parallel aggression, should I say, happening between the Houthis in Yemen and Saudi Arabia, affecting movement in the Red Sea. And now we're seeing Saudi and the United States hitting at targets in eastern Iraq. This is after those militias backed by Iran were reportedly hitting places in Saudi Arabia. So we saw that action also happening. So really new fronts when it comes to the war in general, affecting the market moves, as you can see with Brent prices opened 4% higher this morning.
How about Iran and Oman holding discussions over passage of the Strait of Hormuz? Has there been any encouraging progress there?
Well, that's a good question. We know that the talks between the two countries are ongoing, and essentially our understanding is that both countries are in discussions to open what is so-called a middle passageway in the Strait of Hormuz. Now, Paul, previously ships and tankers had to seek permission from Iran to kind of go through the northern part of the Strait of Hormuz that is closest to the Iranian borders. Not the Omani side. Ships that were taking different routes were prone to getting attacked. And so now the discussions about opening up that middle passageway, we understand that the talks are still ongoing, but for the time being, movement in the Strait of Hormuz is still pretty much paralyzed. Everyone is treading with a lot of caution, especially with the United States maintaining its naval blockade on the strait, despite stopping the attacks over on Friday. And now with this new escalation happening overnight, an expectation of further strikes by the United States is not really far-fetched. So that adds yet another layer of complexity in the region, Paul. But the discussions between Oman and Iran, again, according to our own sources, are ongoing to restore some kind of movement in the waterway.
All right, Middle East correspondent Tabia Abu Omar, thank you. Well, SK Hynix shares have reversed earlier gains after second quarter operating profit missed estimates, and that's despite jumping more than 550%. Bloomberg Intelligence senior analyst Masahiro Wakasugi expects the chipmakers' profits to remain elevated, supported by firm memory demand. Masahiro joins us now. So, Masahiro, how should we read these results, and what happened to DRAM and NAND chips?
The company reported a solid profit, but it missed consensus. And as you know, that Micron reported a few weeks ago, and Samsung as well. So market expected some kind of good average selling prices. And if we try to calculate in detail, probably SK Hynix average selling prices were maybe 5 to 6 or 7 percentage point lower than the maybe market expectation, and partly due to the some products delay, or SK Hynix was saying that some products were pushed to the next quarter. So maybe if we look at the product mix going forward, some SK Hynix product will improve, and profitability could further improve. So maybe that's due to a little bit maybe average selling price calculation.
So what does this tell us about AI demand? Is it slowing down, and what are the implications for the supply chain?
All right. Obviously, we cannot expect very, very strong AI capex, forever, and we could see some slowdown going forward. However, what SK Hynix was talking is that they are making, they made a 10 long-term agreement contract on the memory supply, and it seems to be the duration seems to be a 5-year, time frame. So it means that probably SK Hynix can expect a solid operating profit level or net income level over the, say, for 5 years based on this long-term agreement. So I think that the memory cycle should continue. I think that they are talking to their direct customer as well as probably the hyperscalers as well. So in that sense, we can still expect the AI cycles should continue. And they are expecting some capex increase for this year and probably next year. So product equipment demand should increase. So that should bode well, bode well for some equipment makers as well. And maybe semiconductor material demand should increase over the next 4-5 years.
All right, Masahiro Wakasugi, Bloomberg Intelligence Senior Industry Analyst. Thank you. Well, let's get some more on the global chip sell-off. We're joined by Burke, Research Director of Semiconductors, Supply Chain and Emerging Tech at Futurum. Brendan, thanks so much for your time today. And I obviously want to start with SK Hynix. I mean, incredible profit increase, 557%, but that is not good enough for investors. We've had SK Hynix lose about half of its value since the peak just a month ago. So when you look at enormous moves like this, what do you make of it? What does it say about the state of demand?
Good morning, Paul. Thanks for having me. We're in a period of transition now to the agentic era of the semiconductor build-out. And names that have performed well through the expansion of reasoning and the initial wave of GPU data centers are now being tested for not just how they're going to perform through the rest of this year, but how they're going to do in 27 and 28. And there's a period of consideration here where after all the gains that have been generated through this rapid build out of memory, investors get to take a step back and look at who the next winners are going to be.
Well, on that point, who are the next winners going to be, and what's your outlook for SK Hynix?
Well, the SK Hynix serves a strategic role in the high bandwidth memory, yet there will be new innovations needed to drive agentic processing forward. At the time of their listing in the US, I said that they needed to give investors a story about how they're going to drive innovation and use their CapEx to drive high margin products that change the commodity cycle. And it is those players that work closely with the AI engineering community to develop systems that can produce tokens themselves that will ultimately earn pricing power and be a core part of data center buildouts. Memory is still just a component of that overall system, and it's the combination of components together that ultimately create value for the end customers.
Well, in anticipation of that broader story from SK Hynix, do you buy the stock at this point, or is it catching a falling knife?
I am looking for those innovations that really build the combination of GPUs, CPUs, and memory that are going to be needed to produce tokens at a high rate for agentic systems. And memories has to prove that it's going to keep up with that pace. I think SK Hynix has the ability to develop new products that leverage innovations it's been working on, like high bandwidth flash or processing in memory. There are new chip architectures that can make better use of memory to lower cost of token production. We still have very high cost of memory, and it's unclear that chip system makers are going to put up with them if they can find alternatives. So it is up to companies like SK Hynix to invest in startups, invest in new products, and show signs that they can diversify for the agentic era.
To what degree do you feel some of the Chinese AI companies are showing the way in terms of doing more with less?
Well, it's really interesting, Paul. There are waves of semiconductor cycles where prices come down and low-cost entrants come into the market, and that's what we're seeing with Chinese entrants, both in terms of lithography machines and memory at the moment. Yet the fact remains that the leading edge systems are starting to achieve outsized expectations. When you look at, say, NVIDIA's Vera Rubin system that has been proven recently by CoreWeave to achieve 10x output in terms of tokens per dollar relative to the last generation that only increased about 2 to 3 times. And so simply cutting costs and finding cheaper ways to make the existing technology isn't going to deliver those outsized gains. So while it is valuable to have competition in the market and there are new suppliers coming in, it's ultimately those leading edge players that are going to drive the next generation of systems.
Yeah, you mentioned lithography there, and we did have China sending shockwaves through the market on Tuesday, with the news that China is reportedly working on its own chip etching machines, not to the same level of sophistication perhaps as, say, ASML, but could we add a yet to that sentence? Is it just a matter of time?
Oh, Paul, they're so far behind. It's a complete overreaction by the market. It's like coming up with a new horse and buggy relative to the high NA EUV systems that are being tested in some of the leading foundries in the US and Europe. Those systems are going to be able to leverage new transistor architectures. The DUV machines that are being made in single-digit increments in China are simply going to be able to keep up with the commodity microcontrollers that we've been making for 20 years. And so I think we're well past that being material news. What we really have to look for is these both leading chip systems like NVIDIA Vera Rubin, but also ASML's high NA EUV as those positioned for the next 5 years.
All right, so you've outlined no concerns there, but how about one of the other themes that is causing market jitters around the AI story, and that's the news around circular deal making. I mean, NVIDIA this week went announcing deals worth $750 billion in which it finances, takes stakes in projects that uses its own chips. When you look at something like that, does it cause you to scratch your head and wonder about the sustainability of it all?
Well, NVIDIA has taken a clear stake in its own projects and proving that it can deliver more revenue per system. And so with modeling like the DSX system, they can tell their customers that they're going to make more revenue per watt than before, but once they actually fund those systems and then make a share of the revenue on the back end, it guarantees that there's going to be increased revenue, and it gives them skin in the game to prove that to their customers. And this is a transitional phase where we test the claims that have been made about 30 to 50 times output gains between generations. Maybe it's only 10 times, but if NVIDIA is willing to defray some of the risk for deploying these leading edge systems, leaving the customers with multiple times more revenue per dollar than they expected, then that's going to be a win-win for both sides.
And how about data center spending? Because it's stratospheric at the moment. What sort of earnings metric does big tech need to provide over the next few weeks to prove all the sellers wrong, the skeptics who are concerned about this amount of spending?
Yeah, so the challenge that's come in recently is that free cash flow has gone negative, which means that more is being invested into new data centers than into, say, stock buybacks. But what investors should be looking for is the operating margins of the cloud businesses, because that shows whether the new services that are being launched, such as agentic systems and reasoning models, are increasing the profitability. And indications are that operating margins can continue to grow, even as high as 50% for some of these cloud operators, with Google having landed in the mid-30s. And if we see those signs of increasing profitability at the operating level, then that suggests that going free cash flow negative is actually a positive sign for hyperscaler earnings, and that if anything, they've been investing in their customers to date. And so if we see those signs of closer to the 40% operating margin range, that suggests that this free cash flow investment could be well worth it.
Okay, well, you're constructing an optimistic picture here, but I know that you do feel the real risk to the AI story is energy consumption. How do you see this being solved, and what near-term risks is this posing?
Yeah, so access to energy is a critical bottleneck to be able to onboard more systems. We're projecting that by 2030, the hyperscalers and cloud providers will want to add 45 gigawatts of data center demand. And to do that, they're going to have to get more efficient at building behind-the-meter data centers. Yet this is a challenge that data center operators feel up to. I was at AMD's Advancing AI conference last week, where Meta's head of infrastructure took the power constraints head on and said that they'll be able to deal with it through a mix of behind-the-meter assets as well as leveraging existing resources. And it's going to benefit from leveraging a range of different distributed assets, as well as gigawatt scale data centers in areas where they can be constructed. And it's that efficiency and shift to smaller, potentially air-cooled data centers that could produce the low-cost tokens that enterprises need.
All right, Brendan, thanks so much for your time today. That is Brendan Burke, Research Director at Futurum. Still to come, Rio Tinto's profit surges as high metals prices and cost cuts boost earnings, sending shares higher. We'll break down the company's latest earnings next. This is Bloomberg. Welcome back. You're watching Inside. Just want to get you across an alert on the Bloomberg terminal. Yes, it is from South Korea, and yes, it is related to tech stocks. We've got the Kosdaq now in a trading halt for 20 minutes after falling 8% and staying there for 1 minute, so that triggered the trading halt. Earlier, we had the sidecar activated for the Kospi as well, and a lot of this inspired by SK Hynix's fantastic profit, which was not enough for markets. We've seen that stock declining more than 11% now, and the Kosdaq now in a trading halt for the next 20 minutes. Well, let's talk about Rio Tinto paying its highest interim dividend in 4 years after first half profits soared on strong commodity prices and a restructuring drive. Asia Trade co-anchor Heidi Stroud-Watts joins us now with more. And Heidi, that shouldn't feel weird to say this, but company delivers good results, stock goes up.
Well, yeah, particularly on a day when, you get a 557% gain in quarterly profits and the markets are disappointed with SK Hynix, right? But no disappointment as such when it comes to Rio Tinto. There were some concerns that, given all of the macroeconomic factors, US-Iran war as well, the supply disruptions, that, what would we potentially see, not to mention the tariff war as well. Would that be eating into commodities demand? But all of this has actually boosted commodities prices, even when it comes to the iron ore part of the story, which is a little bit softer. But I suppose what's really interesting is that some of this has come through from the productivity efforts, right? $870 million from that number is being banked from these efforts to try and streamline and make the company more efficient. And we've also got those gains of $3.6 billion from stronger commodity prices. Breaking that down in terms of the key production elements, obviously iron ore is one. It's interesting, Simon Trott, the CEO, spoke about this being an evolving market. We know that waning demand story, the K-shaped economic recovery, I should say, story out of China is part of it. And we also don't know what these kind of supply agreements going forward will be from China Mineral Resources Group. These negotiations are still ongoing for forward supply deals. Copper was kind of the standout. We've seen copper prices climbing about 10% on the back of this sort of, enthusiasm for the transition metal. The question we'll be putting to Simon Trott when we speak to him later this hour is how they're going to secure that future demand right beyond the mine in Mongolia. Yeah, the oil mine doing a lot of heavy lifting right now, isn't it? So yeah, all good questions for Simon Trott. That's the Bloomberg Asia Trade co-anchor Heidi Stroud-Watts. He's going to be sticking with us later on because coming up, as mentioned, we will be speaking to Rio Tinto CEO Simon Trott. But before that, we're going to look ahead to a Fed meeting that has markets unusually uncertain about whether we'll see a hold or a hike. We'll have more from BlackRock's Navin Saigal next. This is Bloomberg. Welcome back. You're watching Inside. Let's take a quick look at where markets stand. We do have mainland Chinese markets heading out to lunch. Japan, meanwhile, coming back online. So in terms of where we're positioned, we've got the Nikkei off by about 1%. Anything exposed to the tech story is having a bit of a rough day today. We've got the Kospi down 8% now, so getting very close to seeing a trading halt there as well. We've already had the sidecar activated briefly for Korea earlier today. A lot of this inspired by that
that SK Hynix result, I mean, which, the headline number looked like it blew it out of the water. Profit up 557%, but the market expects a lot more than that from this stock, so some disappointment there. SK Hynix weighing on the market. It's about 50% off the peak that it experienced just a little bit over a month ago. You see it now down 12.4%. Elsewhere, take a look at the oil price. We've got crude rising again. Brent 87.50 a barrel. This is after the relative calm in the Middle East was shattered. Iran launching a surprise attack on a US base in Jordan. US Central Command saying all those missiles were intercepted, but it did once again underscore the fragility of that situation. We also had US oil stockpiles falling by 3.3 million barrels last week. Now, we need to talk about US Treasuries as well, because if those two factors weren't enough, there is more uncertainty hovering over the markets at the moment. Let's take a look at how bond yields are tracking right now. The 10-year 4.61% at the moment, off that 4.7 level that we saw a few days ago. So yields pulling back a little bit, but still a fair bit of uncertainty hovering around the market at the moment. If we look at futures in terms of pricing for what the Federal Reserve is going to do, that's the screen on the right there, probably about a 1 in 3 chance that we do get tightening from the Fed at this meeting. Open interest in federal funds futures, if you're interested in the stats, reaching just over 909,000 contracts on Friday and then rose again to 967,000. So this reflects the unusually large divide over the Fed's next move. Our next guest thinks the Fed is set to hold rates steady in the near term. Let's get some insights from Navin Saigal, the Asia-Pacific head of global fixed income at BlackRock. Navin, thanks as always for your time today. So you're in camp hold, but is there at least some small part of you, perhaps 1/3 of you, that thinks we might see some tightening?
Hey, Paul, thanks for having me on the show. It's a great question. There's always a chance that, that we're wrong. But I think given what Chair Warsh has said in his last press conference, he wants to wait for more data to make a more informed decision. And I don't think he's got the data that he needs yet. Everything he's doing points to wanting to be roughly right rather than precisely wrong. He wants to look at the left side of the inflation decimal rather than the right side. That suggests wanting to get the broader themes right. So I don't see a need for the Fed to rush into either a hike or a cut, frankly, because I don't think they have the full information around where the economy is going. I mean, there's a ton going on the inflation front. We don't know where the Middle East situation is going to land up. There's a ton going on the investment front. That's a major driver of the U.S. economy today, and we don't yet know exactly where next year's capital spending numbers are going to end up. So I don't think it's crazy to hold for some time and wait for those pieces of information to come in.
Navin, just hold that thought for a moment. Just get viewers across a little bit of breaking news here. As anticipated, the Kospi now entering a trading halt. We've seen a plunge of more than 8% for more than a minute now. So there'll be another 20 minutes without trading for the Kospi today. It's right now off 8.17%. Navin, just picking up on your theme for inflation, and you mentioned the oil-inspired component of this. How challenging is it to model inflation projections at the moment, and how enduring inflation might be?
I think it's pretty challenging, but I do think that inflation, the battle with inflation, the big battle, has been largely won. And 3% inflation is not a terrible thing when the economy is humming along in the way it is. Unemployment is doing okay, and the labor market situation is okay, and nominal growth is chugging along at 6%. So to some extent, I'd say 3% inflation may be part and parcel of a robust economy. And if it ain't broke, why fix it? I think that's the angle that the Fed will come from.
Well, we've got 3 meetings left after this one, and if this is a hold, when might you expect tightening, if at all, in any of those next 3? And I've particularly got an eye on the October one. How likely is it the Fed would be willing to lift rates right before the US midterms?
Well, I think that there's a lot of focus on oil and inflation. There's not as much focus on the longer-term deflationary trends from some of the capital spending that we're seeing from the tech companies. I mean, their objective is to reduce costs and disintermediate to some extent parts of the labor market that can be made more efficient. That's a very deflationary trend in the longer run. Now, on the back of this, you've had bond yields reset higher. You mentioned the 10-year Treasury earlier on, Paul, and I think there's a lot of focus at the long end. There's much less focus on what the front end of the curve can do for investors during a time of elevated uncertainty, whether it's in stocks, whether it's in inflation. That elevated uncertainty can be combated from the portfolio standpoint with a steady and stable income stream at the front end. So I think holding that front-end fixed income portfolio and clipping that coupon of about 6-7% is a really great way to ride out some of this uncertainty in inflation, with uncertainty in capital spending. We are very comfortable with that portfolio.
And how far out on the curve do you think investors should be looking at the moment?
I think the 3 to 5 year point is the sweet spot. You get a little bit of term premium moving out from cash and bills. But you also get the benefit of if, for example, there were to be a drop in capital spending, and I mentioned investment is one of the major drivers of US growth at the moment, then you'd expect that economic impulse or the negative impulse on growth to bring market expectations back to more in line of a probability of a cut. And to be in that 3 to 5 year zone, you get some exposure to that.
I need to discuss with you Indonesia as well, because we've had that leadership change, or there will be one at Bank of Indonesia shortly. How do you see that affecting the nation's bond market? What are the biggest risks for Indonesia going forward?
Yeah, the country's bonds, Indonesian government bonds, aren't that exciting from a yield perspective. I mean, I think wherever you look today, you find attractive income streams, and I think Indonesia certainly fits in the grand scheme of a basket of Asian bonds that can be very complementary to a global multi-asset portfolio. But in and of themselves, they don't stand out as being particularly cheap. Now, on the one hand, you can say, yes, it's not particularly cheap. On the other hand, I think the market is telling you that they are not that concerned. The market is not that concerned about the credit worthiness of Indonesia. I mean, the dollar bonds trade pretty tight, actually. So the market is not very concerned. I think there is certainly some uncertainty in the political, next political moves and what the current regime would like to achieve for the country. But I wouldn't say that there's any particularly strong conviction on Indonesia at these yields.
Yeah, well, we've got a situation where the governor of the central bank is gone, the finance minister is gone, the president of the country has appointed a nephew to the central bank board. When you put all this together, do you have any concerns about policy independence in Indonesia?
I mean, my job is to assess whether or not we're being compensated for political risk in the government bonds. And I think today you do get some compensation. As I said, it's not particularly cheap, but you get some compensation for those risks. But I don't think, I think the market will have to assess whether the government is more oriented around fighting things like inflation or pro-growth. And I think which way they go will can end up determining which way bond yields and the currency go.
All right, Navin, thank you so much for your time today. That is Navin Saigal, Head of Global Fixed Income for Asia Pacific at BlackRock. Coming up next, Rio Tinto CEO Simon Trott joins us exclusively to discuss the miner's first half profit surge and its push to make copper a bigger driver of future growth. This is Bloomberg. Welcome back. You're watching Insight. Let's check in on Rio Tinto shares at the moment, having a pretty good day, better by about 4.5% at the moment. This is after first half profit. Rose underlying profit up by 43% to $6.85 billion. Strong commodity prices, a number of years of a restructuring also helping to boost earnings here. So the stock performing pretty well. It was already up about 8% year to date. So let's get a little bit more on Rio Tinto. Heidi's back with us alongside our exclusive guest, CEO Simon Trott. Simon, thanks so much for joining us today.
Great to be here. Thanks.
Now, talk to us about your approach, because you said from the outset to slim down, streamline the company. Even this morning you're using words like relentless, significant when talking about cost savings, looking for productivity gains. So can you talk to us about your plan for the next half? What's next?
So we set out a plan last year, stronger, sharper, simpler, and we talked about building a stronger Rio Tinto, a more agile Rio Tinto, and really pleasing today to see that coming through in results. So profit up significantly, free cash flow up 75%, allowing us to pay a significantly increased dividend over $3 billion back to shareholders, and all of that really due to strong markets and due to the work that we've been doing internally to really make sure we're building as strong a Rio Tinto as possible. I guess what I'm most excited about though is how we're positioned for the future. So we've slimmed down the portfolio to focus on copper, aluminium and lithium and iron ore. They're the commodities where we have the asset base and we see the greatest growth potential. And you look forward to the underlying demand, particularly from those big trends of our time, AI and digital, traditional demand, electrification, really well positioned to take advantage of that.
Yeah, I do want to talk about your role in the AI story a little bit later. I mean, it's affecting everything it touches at the moment, but I think you promised, or mentioned this morning, there's about another $5 billion worth of divestments to come. Can you talk to us about some of the non-core assets that you're looking at? And I know you've got a small Canadian iron ore mine, for example. Would that be one that's on the chopping block?
So we talked about releasing $5 to $10 billion from the balance sheet, and so that includes some assets that we'd put under a strategic review, but it also just looking across the portfolio to really make sure the balance sheet's working as strongly as we would like. We also promised around $650 million in productivity savings, and today we announced we'd already banked $870 and almost tripling the run rate, so $1.8 billion by the end of this year.
Now, iron ore is still so central to what you do, generating the largest amount of your revenue. This is despite Chinese demand reaching a plateau. We've still got prices holding up pretty well. How's your negotiation going, though, with the Chinese state-backed buyer? Can you give us an update on that? What are they asking for? And is there a risk that they could ask for similar things for other commodities?
So iron ore remains a really strong market for us. We've been talking for years about the maturation of China growth, and you're certainly seeing that come through. It's been far more resilient than I think market pundits had expected because of that underlying demand. And whilst construction in China has slowed, you've seen a real pickup in export-related steel demand, so secondary and tertiary products. And that's led to fairly robust and stable pricing outcomes in the market. We continue to engage with all market participants, including CMRG. And so, through the ordinary course of business, we renew those contracts, and that's the phase we're in at the moment.
You've talked about that market evolving, though, and obviously at the moment that the economy is in a K-shaped recovery, and the property sector, fixed asset investment, probably isn't going to come back unless they return to the old economic playbook. Do you see the plateauing going downwards? What sort of a sort of sharper slowdown might you be envisioning?
We've certainly seen over a period of years that construction segment slowing down, and it makes up a relatively smaller portion of our book now compared to 5-10 years ago, whereas really one of the big drivers. And as I say, you've seen that demand being replaced by export related, not necessarily steel exports of themselves, but related to the increase in manufacturing within China and those products flowing to the rest of the world. I think domestic supplies and scrap have probably been a bit less in terms of on the supply side than predictions, and so that's led to stronger pricing outcomes and pretty good cost support. Is probably the last point I'd make. Increases in raw materials, particularly energy, has meant that it's pretty well supported prices on the right-hand side of the cost curve.
Obviously, more strategically important going forward is the role of copper, right? And prices demand has held up pretty well this year. Beyond Oyu Tolgoi, where do we look next in terms of guaranteeing future demand?
So one of the things we outlined today is around 70% of the raw material cost of a data centre comes from the materials that we produce. So, aluminium, copper, lithium, as well as steel. And if you look forward, the spend next year on from hyperscalers, $1 trillion and you convert that across, that's a lot of lithium, aluminium and copper. And so really excited about how we're positioned for the future. Fortunately, we've got Oyu Tolgoi, which is ramping up to the 500,000 tonnes of capacity. That ramp up's proceeding according to plan, and really pleased with the way that asset continues to perform. Kennecott in the US, one of only two copper smelters, and then a big pipeline of growth beyond that. So we'll move to 1 million tonnes by the end of this decade, and then the projects to support that going forward.
Can you tell us more about the pipeline of growth beyond that? Where do you see new copper mines coming from, or are you looking at M&A?
So Resolution in the US, we're currently drilling that ore body, having got the land exchange that we needed. A few years away. Very well positioned, obviously, in the US, up to 25% of US copper demand. La Granja, Winu here in Australia, and some exciting exploration projects as well.
It's interesting looking at the breakdown. 43% of EBITDA, obviously, still iron ore. Aluminium is about 20%, I believe. Copper 10%. Lithium, very, very small amount, right? Over the next few years, you give me the time frame, how do you expect that mix to start changing?
So I think the big shift in our portfolio, and we've talked for some time about being more divested, what you're seeing in today's numbers is that's starting to come through. So 57% of today's EBITDA coming from aluminium, copper and lithium, and that's a change compared to a few years ago. And so we want to continue to diversify the company. What we really, and why we focused on those commodities, is making sure we have a really strong position in each of those commodities, but we also have growth projects across the 4 commodities going forward. And so, I think one of the lessons of the resource business is you want to have lots of options, and then capital, the projects compete for capital, and that leads to the best outcome for shareholders.
The sort of, I guess, leadership flagship for you has obviously been the divestment, the streamlining, the cost efficiencies. When it comes to frontline mine site decision making, can you talk us through that and how that sort of plays into it? And also, I guess everyone wants to know, when it comes to operationally, where do you see AI increasing those efficiencies too?
So AI is already having an impact in our business. The ability to use big sets of data. I mean, you think about the amount of data that we produce across operations around the world. Being able to harness that for better decision making is going to have a lot of benefits for our business. One of the things we've really been trying to do is make sure that we move decision making as close to the point of impact as possible. The people that best understand our business are the people that are closest to it, and so that's been a significant push, and really starting to see some of the benefits flow. We've got 80 initiatives around the business to help make our business stronger. We need to empower people at the front line and take some of the barriers out of the way.
In terms of the AI story, are you noticing any change in behaviour around generalist investors? Are they coming back to mining because of or in spite of the AI boom?
I think generalist investors are looking at the build-out of data centres, the build-out of the grid, the build of electric vehicles, and clearly one way to play that is directly through tech companies, but they take materials. 70% of the raw materials into a data centre, more than 60% into an electric vehicle, comes from the products we produce. And so we've got good exposure to that, and it means the commodities that we've chosen to focus on are really well positioned for the future.
We haven't talked about the cost side of things yet, because of course no one is immune to those input costs from the US around war. Can you talk to us about how that's been impacting you and how you're managing them?
So there's probably 2 bits around that. Firstly, making sure that we've got access to the raw materials we need for our business, and obviously energy is top of mind, but it's some of those secondary and tertiary products where I think the commercial team's done a great job in terms of managing through some of the potential disruptions. And looking forward, we need to continue to do that. And the second bit is just that cost side. It did have an impact in terms of our cost through the first half. The productivity program more than offsetting that, but just underlining the importance of making sure we have as strong a business as possible.
There's also been the tailwind though, right? Because part of the support for aluminium has been, for example, the supply disruptions in the Middle East. How long do you think that will continue for in terms of the sustainability drive, or do you think a lot of that will still come down to fundamentals?
You're seeing really good cost support, iron ore, aluminium, probably a bit of more investor sentiment, copper, lithium that's there in some of the pricing outcomes as well. It does tend to push producers on the right-hand side of the cost curve. I guess it's one of the privileges of having the cost position we do across the 4 commodities that are a bit less intensive in terms of raw materials inputs and probably a little bit less exposure to some of those increases.
Yeah, that US-Iran conflict, a bit of a double-edged sword in many respects. I mean, we've got aluminium prices well supported due to the war, but once some of those Gulf smelters start coming back online, what's your projection for aluminium prices?
And it's hard to talk about conflict without noting the terrible human impacts of that as well. In terms of the impact on our business, there has been disruptions out of the Middle East. Some of that is temporary. Some of that will take a little bit longer to return. But we make our supply projections on long term. There'll be fluctuations in the short term as some of those disruptions are worked through. But in the longer term, aluminium is going to be well supported because the world needs more aluminium and needs more aluminium for all the trends I've talked about.
How much more diversification do you think there would be? Because there's obviously, as we talk about the war, as we talk about AI, there's a whole host of other metals that have now come into the fore. I know that streamlining probably doesn't go hand in hand with looking at picking up assets as well, but are you always opportunistic in that sense?
Yeah, and we do have opportunities within our existing portfolio. And so in our aluminium business, for example, we can produce some of these minerals that are needed to support the electrification and AI and data, and we're certainly doing that and looking for more opportunities in that space. I think the broader point, you've got to make sure that you focus on where you've got competitive advantage and where you can really liberate some value. And so if you try and do everything, you get nothing done. And so we've got to be really disciplined about where we put our efforts.
All right, Simon, thank you so much for your time today. A very busy day for you as well. That is Simon Trott, CEO of Rio Tinto. Also, Asia Trade co-anchor Heidi Stroud-Watts is joining us on a day where Rio Tinto delivered a solid set of numbers, 47% on-year increase for the first half. Let's take a look at how Asia benchmarks are tracking. Meanwhile, a bit of a mixed day here in Australia, doing very well. Helped in no small part by being underpinned by that materials sector. Rio Tinto, one of the best performing stocks. Elsewhere, though, very different story. Kospi off 8.1%, now the Kosdaq off 8.8%. Both of those indexes entered a trading halt this hour. They are back trading now. But the result of SK Hynix, despite that huge increase in profit, letting down the markets and weighing down on tech stocks more broadly. All right, before we go, let's take a look at tomorrow's show. Dr. Reddy's Laboratories CEO Erez Israeli is going to join us to talk about how President Trump's tariffs on generic drugs will impact pharma companies and consumers. Also, we'll get the outlook for FX markets following the Fed's interest rate decision with ANZ's Majid bin Zaman. That is it, though, for Insight. Horizons Middle East and Africa up next.